Hey everyone, welcome back to Corporate Decoder, the place where we decode the hidden language of business. And today we're looking at Duke Energy Florida's latest pronouncements. And let me tell you, it is all about the money, specifically millions and millions of dollars in bonds. Before we dive in, if you love getting clear, actionable insights from these dense corporate reports, make sure you are subscribed. And hey, we've got a fantastic community over on Discord, linked in the description, where we break down these filings even further. Come join the conversation. Alright, so Duke Energy Florida, a big player in the Sunshine State, has been busy. They've just announced the closing of a pretty significant financial deal. And this isn't just small change we're talking about. They've managed to secure a whopping $1.1 billion by issuing new bonds. Think of it like this. They're borrowing a massive amount of money, but they promise to pay it back with interest over time. This is a standard way for big companies, especially utilities, to raise capital for their operations, expansions, or to refinance existing debt. Scroll pursuant to Section 13 or 15 of the Beer Securities Exchange Act of 1934. Scroll, this is a formal report to the US Securities and Exchange Commission, or the SEC, which is basically the watchdog for the stock market. Companies like Duke Energy Florida have to file these reports to keep investors and the public informed about what is going on. This particular report, a Form 8K, is used for significant events that shareholders should know about right away, and issuing over $1 billion in bonds definitely qualifies. So, what exactly happened? Duke Energy Florida sold these things called first mortgage bonds. They issued two types, some will be paid back in 2030, and others in 2035. The total amount they raised is $500 million for the 2030 bonds and $600 million for the 2035 bonds, making it a cool $1.1 billion in total. They worked with a bunch of big investment banks like CBC World Markets Corp, Citigroup Global Markets Inc., and Morgan Stanley and Company LLC to handle this sale. These banks are called underwriters, and their job is to help the company sell these bonds to investors. The bonds were sold at a slight discount to their face value, which is typical when you are raising such a large sum. Let's break down those bond types a little. The first mortgage bonds basically means these bonds are backed by a claim on the company's assets, which makes them generally safer for bondholders. The numbers like 4.20% and 4.85% are the interest rates or coupon rates they're paying on these bonds. So, for every $100 they borrowed, they'll pay $4.2 per year in interest for the 2030 bonds and $4.85 per year for the 2035 bonds. The dates 2030 and 2035 are when the full amount borrowed, the principal, needs to be repaid. This strategy of issuing bonds with different maturity dates helps manage their debt over time. Now, all of this is documented in a thick legal agreement called an indenture. This specific issuance is covered by something called the 63rd Supplemental Indenture. Think of it as an amendment to a very old master agreement governing these bonds, which dates all the way back to 1944. The Bank of New York Mellon is acting as the trustee, which means they are an independent party that oversees the bond agreement on behalf of the bondholders, making sure Duke Energy Florida holds up its end of the bargain. The filing also lists all the supporting documents or exhibits that back up what they're reporting. These include the actual indenture agreements, legal opinions from lawyers saying these bonds are valid, and the underwriting agreement with the investment banks. These are the nitty-gritty legal and financial pieces that confirm the deal is legit and properly structured. It is like the detailed blueprints for this massive financial construction project. Alright folks, so what does this all mean for us, the everyday observer or potential investor? On the surface, it is a sign of a company that is active in managing its financial structure. They're raising a significant amount of capital, likely to fund their ongoing infrastructure projects, maintain their power generation facilities, or perhaps to pay off older, more expensive debt. For Duke Energy Florida, this is a fairly routine, albeit large, financing operation. It shows they have access to credit markets, which is crucial for a utility company that needs constant investment to keep the lights on and grids updated. The fact that they're issuing bonds with interest rates of 4.20% and 4.85% gives us some insight into the current cost of borrowing for a company like this. These rates are influenced by many factors, including the company's creditworthiness, overall interest rate environments, and market demand for such bonds. While these numbers themselves might not tell a dramatic story of immediate crisis or unprecedented prosperity, they are a snapshot of the company's financial health and its ability to secure funds. Looking at this from more of a Warren Buffett style of analysis, Duke Energy Florida is essentially making a bet that the returns it can generate from the projects funded by this debt will be higher than the interest it has to pay on the bonds. As a utility company, their revenue streams are generally quite stable and regulated, which makes them relatively predictable investments. However, the biggest risk for any utility is often regulatory changes, unexpected costs for fuel or maintenance, and the capital required to transition to cleaner energy sources. This bond issuance itself doesn't reveal those deeper operational risks, but it is a piece of the puzzle in how they're funding their future. In conclusion, Duke Energy Florida has successfully raised a substantial sum of money through bond issuance to support its operations. This is a standard yet important financial maneuver for a company of its nature, demonstrating its access to capital markets. While the numbers are large, they represent a calculated step in managing the company's financial obligations and future investments. What is your take on Duke Energy Florida's financial strategy? Do you think this kind of debt financing is a sign of strength or a potential future burden? Let us know your thoughts in the comments below. If you found this breakdown helpful, please hit that like button, it really helps us out, and subscribe for more deep dives into the world of corporate finance. And don't forget to join our growing community on Discord, linked in the description. Thanks for watching, and we'll see you next time on Corporate Decoder.